So let's get into Chapter 7 of Corporate Taxation, where we're talking about non-liquidating distributions. So we all know that tax can sometimes be like an onion, right? It's got layers. So let's start off the video by praying to whichever God you believe in. For me personally, it's the big statue at Sam Houston, which I drive in every day, and let's get into it. Current earnings and profit. Current earnings and profit are the total amount of money that we could possibly distribute to our shareholders. There's going to be three main segments in this calculation, and it all starts with our net income. So we have our revenue, we add in any capital gains that we receive, add in any, even if they're tax exempt, life insurance proceeds, take out any expenses like cost of goods sold or depreciation expense and meals expense. Now, when we look at taxable income, we know that maybe for an asset we have done bonus depreciation instead of straight line, in which case we would have more depreciation deduction than we would in net income. So then we have to subtract that difference to bring the depreciation down to the amount that we want to deduct. We have to add back 50% of our meal expense, since we're only allowed to deduct 50% of meals expense for tax purposes. We might subtract out that life insurance proceeds because they're tax exempt, subtract out carryover capital losses, since carryover capital losses from a prior period will now net against our capital gains, subtract out the NOL deduction, and add back penalties and fines, since we cannot deduct them for tax purposes. And that'll give us our taxable income. Taxable income will then lead us to our current earnings and profit. So it depends on our depreciation system if we are adding depreciation or if we are subtracting. So in this case, if we used bonus depreciation and the ADS depreciation was lower than the bonus depreciation, we would have to add back a certain amount so that we aren't over deducting our depreciation. We can subtract out half of our meals now, since we want to bring it back to that original cash outflow. We add back those life insurance proceeds, since tax-exempt life insurance is still considered a cash inflow. We add back a net capital loss carry forward, add back our NOL deductions, subtract our penalties and fines, and finally subtract our tax liability. The reason why we subtract our tax liability is because we have our taxable income, we multiplied it by that 21%, and then that is a true cash outflow. We can't deduct our tax liability from taxable income because we need our taxable income to calculate our tax liability, but we can deduct it from current earnings and profit since there is a real cash outflow. So let's get into an example. This year, Jolt Incorporated reported $40,000 of taxable income before any charitable contribution deduction. Jolt contributed $10,000 this year to Goodwill Industries, and we want to compute the company's current earnings and profit. Although there are only two amounts, and it seems like this might be an easy one, it's actually pretty long. So we're always going to start with our taxable income, which is $40,000. Then we know that the charitable contribution deduction limitation is 10% of our taxable income. So we need to take 10% of our taxable income, $4,000, and that gives us total taxable income, $36,000. Now we are going to recognize our liability, which is the 21% of $36,000, and then we're going to start all over again with our taxable income, like in our current earnings and profit calculations. So start again with that $36,000. Now we already recognize that we took $4,000 from that contribution, but we actually contributed $10,000. So there was a real cash outflow of $10,000. We already recognized that we took out $4,000. So now we need to recognize that other $6,000 has been a cash outflow, has left us. So we also take out our taxable income, our taxable liability, which is that $7,560. That leaves us with our current earnings and profit of $22,440. Let's get into a little bit of a longer example. So let's take all of these little items one for one. So depreciation, $50,000 of depreciation, which is bonus depreciation. If we look at that last sentence in the example, depreciation using the ADS system is $30,000. So that tells us that we're going to add back $20,000 because currently in our taxable income we have over depreciated $20,000. Now the $7,000 of dividends received deduction, we need to add that money back as well, since that dividends received deduction didn't actually create any cash outflow. The $3,000 net operating loss carryover will be added back since that was from a prior period and there wasn't a cash outflow in this period for that carryover. And then $5,000 of tax exempt interest, which is currently not included in our taxable income, will be added back so that we recognize that we have interest income that hasn't yet been included in our taxable income. $6,000 of entertainment expenses, which are not allowed to be tax deductible, will now be tax deductible for us. And then we have a $4,000 net capital loss from the current year. This one is a little bit of a tricky one because it's from the current year, which means that all of our capital losses which we have had have already netted against our capital gains. So our capital gains have been brought down to $0, and we have in excess of a net capital loss of $4,000 for this current year. In our net income calculation, we would have subtracted this excess net capital loss. However, in our taxable income, we would have added back this net capital loss since we know that you cannot recognize a loss in excess of the capital gains. So in our current E&P calculations, we need to subtract this net capital loss again, like we did in net income, to recognize that there was a true cash outflow. If we look at the first sentence as well, we can see that we also paid federal tax income of $2,100. So we start with our taxable income of $10,000, add back that tax exempt interest of $5,000, add our dividends received deduction of $7,000, plus our net operating loss carryover of $3,000. That depreciation calculation we'll look at in a second. Subtract out our federal taxes, subtract out our entertainment expense, which was not tax deductible, but we can recognize that cash outflow for current E&P, and then subtract out the net capital loss that we had for this year. Two notes that I wrote down were the depreciation calculation and the net capital loss explanation. So positive earnings and profit and positive accumulated earnings and profit. Whenever we talk about distributions with earnings and profit, we always talk about 3 steps of distributing income. First, we distribute it as a dividend. Once all of our current earnings and profit is gone and all of our accumulated earnings and profit is gone, then we reduce the shareholders' tax basis. Once the tax basis is completely reduced to 0, the shareholder will recognize the rest of the distribution as a capital gain. Let's look at an example. CSR reported current E&P of $40,000 and the balance in accumulated E&P was $16,000. On December 31st, SCR distributed $48,000 to Jacob and $16,000 to Ginny. And we want to know what amount of the dividend income or return of capital did Jacob and Ginny report, and what is accumulated E&P for SCR at the beginning of the year. We also want to know what is each person's remaining stock basis. So I made these numbers up right here. Jacob's basis is 37,500 and Ginny's basis is 12,500. These amounts also reflect their amount of ownership in the company. So Jacob owns 75% and Ginny owns 25%. If we look at these distribution amounts, 48,000 and 16,000, which add up to be 54,000. and then we add our current EMP and our accumulated EMP, which would add up to be 56,000, we know that we want to distribute more money than we actually have in our earnings and profit, current and accumulated. So let's start off with the amount of dividend income that they have. Jacob is going to recognize 42,000. Ginny is going to recognize 14,000. We could first take 75 and then 25% of current EMP. I've added them together to the 56,000 since we already know that the EMP is not going to cover this distribution. So Jacob takes his shareholder percentage, 75%, multiplies it by the 56,000, and we get 42,000. Ginny does the same thing, she gets 14,000. Next, we want to know how much of this is going to be a reduction in their stock basis. So Jacob is still owed $6,000 and Ginny is still owed $2,000. Also, once these amounts are distributed, both of the earnings and profits are depleted, so both have a balance of $0. So just like we said, the $6,000 that is still owed to Jacob and the $2,000 still owed to Ginny will be recognized as a reduction in capital. And that's because both people have enough in their stock basis. So Jacob has the 37,500, Ginny has the 12,500. Both have enough in their stock basis that they can reduce it by $6,000 and $2,000. Jacob's new stock basis is just his old stock basis minus the reduction. Same for Ginny. Okay. An important note to make now is that the only thing that can decrease current accumulated EMP is a loss. So a distribution will never decrease a current accumulated EMP. So let's look at an example. We have current EMP of $10,000. The balance in accumulated EMP is negative $20,000. On December 1st, we want to distribute $48,000 to Jacob and $16,000 to Ginny. Jacob has a basis in his stock as $42,000. Ginny's basis is $10,000. What amount of income will Jacob and Ginny report? What tax basis will both have after the distribution? And what's the balance in the accumulated EMP at the end of the year? So Jacob and Ginny continue to have their ownership percentages of 75% and 25%. Jacob's going to report the $7,500 as dividend income. We're going to take first from the current EMP and deplete that as much as we can. Ginny's going to report $2,500 of dividend income, which is calculated using the 10,000 multiplied by the 25%. After that, we need to reduce their stock basis. So Jacob can reduce his stock basis by the remaining 40,500 that we need to use to get rid of his total distributed amount of 48,000. And we found that by using the 48,000 that we want to distribute to Jacob, subtracting out the 7,500 that has been distributed to him as dividend income, and that gives us the 40,500. Now, the reason that we can do that as well is that Jacob has a basis in his stock of 42,000. So there is enough in his stock to reduce it to 40,500. Ginny reduces her tax basis by 10,000. Now, she only has an original tax basis of 10,000, and she needs, after this $2,500 dividend income distribution, she still needs to distribute, or we still need to distribute, $13,500 to her. We found that by using the $16,000 that we want to give to her. We've subtracted out the $2,500 that we have already given to her. But we've recognized that the $13,500 that we would like to give her is exceeding her tax basis of $10,000. So her tax basis is now depleted, and we only recognize a reduction of $10,000. Ginny's going to have to go to that third step, which is a capital gain. Ginny's going to recognize $3,500 of a capital gain, which is just the amount that exceeded her tax basis minus the amount that we depleted her tax basis by. Okay. Now, Jacob still has tax basis of $1,500, and we got that by taking his original tax basis of $42,000 and subtracting the amount that we depleted his basis by of $40,500. Now, what is the balance of accumulated E&P during the year? So actually, this amount that I've written down is incorrect. It's going to be negative $20,000. I don't know where I got 16, but that was in my mind. So $20,000, negative $20,000 still, since the distribution was too large to allow current E&P to replenish it. Okay. Negative E&P and positive accumulated E&P is a little trickier just because, again, we cannot distribute income if the distribution will create negative accumulated E&P. So that brings our time equation back into effect. We need to figure out how much of this negative current E&P, because remember, we calculate our current E&P at the very end of the year. So we want to know how much of this negative current E&P do we have to net against our positive accumulated E&P before we distribute. Okay, so I've given an equation which is accumulated E&P minus our negative current E&P times the time equation, and that equals our allowable distribution. And we'll take a look at that right now. SCR reported current negative E&P of 20,000. However, the balance in accumulated E&P at the beginning of the year was 60,000. On July 1st, SCR distributed 48,000 to Jacob, 16,000 to Ginny. Jacob now has a tax basis in his stock of 24,000. Ginny's stock basis has remained 10,000. What amount of dividend income do Jack and Ginny report? What is their basis in the stock after the distribution? And what is the balance in accumulated E&P at the end of the year? So first of all, we need to recognize we have distributed this money to Jacob and Ginny on July 1st. So let's count the months. January, February, March, April, May, June, right? On June 30th. So those are the first 6 months in the year of time has passed before we've done this distribution. So our current negative E&P is $20,000. We need to multiply that by 6 over 12. By 6 over 12, since that's our time equation in effect right now. So current negative E&P is going to become negative 10,000. And we're going to see that our dividend income of 37,500 is distributed to Jacob and 12,500 is distributed to Ginny. Since we've netted that 60,000 accumulated E&P against the new number of current negative E&P of $10,000. So our allowable distributed amount becomes $50,000. And again, that was the accumulated E&P, which is positive $60,000 minus $10,000, which we got through the negative E&P amount multiplied by the time equation. And then we just multiply by each shareholder's percentages to find the distribution. So Jacob was 75%, so we take 75% of 50. Ginny was 12,500, which is 25% of the allowable distribution amount. After that, we need to find their stock basis. So Jacob's stock basis is going to be 13,500. Now, a couple different calculations go into this. We are going to reduce Jacob's stock basis by the remaining amount of $10,500. We wanted to distribute to Jacob $48,000, but we could only distribute as dividend income $37,500. So we reduce the distribution that we want by 37,500. That gives us 10,500. And then we have to reduce his stock basis, which is 24,000, by the 10,500, which gives us 13,500. Ginny's stock basis is going to be 6,500. We do that by taking our amount that we wanted to distribute to Ginny, which was 16,000, subtracting the amount that we have already distributed, which is 12,500, and we get that we still need to distribute to Ginny $3,500. Now, Ginny's original tax basis was $10,000, and then we subtracted her tax basis by $3,500, which is the remaining amount that we needed to distribute to Ginny. Now, accumulated E&P, so remember we had negative 20,000. We already netted a negative 10,000 against the accumulated E&P, and we have depleted accumulated E&P completely. So we have distributed the whole $50,000 that we had left in accumulated E&P, which means on the second half of the year, the other 10,000 amount of negative E&P is going to become our accumulated E&P. So again, we had $60,000 of accumulated E&P. We subtracted out the first half of the year, which was $10,000. Then we subtracted out $50,000, which was our allowable distributable amount. That left us with $0 in accumulated E&P. But we can't stop at that negative 10,000 because we had negative 20,000. So we have to recognize the other half of the year, which is a negative 10,000. So then we have negative accumulated E&P of 10,000, right? And then I have that one more time written down. Hold on. Right here. Okay, it's not going back. Moving on. We have negative E&P and negative accumulated E&P. So special rules with this is that we will never have dividend distribution or dividend income to our shareholders. It will always be zero because we don't have any cash to give them. We can't take out of negative E&P. We can't take out of negative accumulated E&P. We just don't have anything to give them. But we still want to distribute, right? We still want to keep our shareholders happy. So we're going to assume that SCR reported current E&P of negative $50,000. The balance in accumulated E&P at the beginning of the year was negative $60,000. Jacob has a tax basis in his stock of 24,000. Ginny's tax basis in her stock is 10,000. December 1st, 2025, SCR distributed 48,000 to Jacob, 16,000 to Ginny. What amount of dividend income do Jacob and Ginny report in 2025? So, starting with dividend income, we already know zero. Both parties get zero. There's nothing to give them. Both stock bases are also going to be reduced to zero, right? Jacob, we want to distribute 48,000 to him. He has a stock basis of 24,000. We have to get rid of it all. He reduces his stock basis to zero. Ginny is also going to be $0. She's $16,000 minus the $10,000 in her stock basis. Now, the capital gains are going to be 24,000 by Jacob, which is just the difference between 48,000 and 24,000, and 6,000 by Ginny, which is the 16,000 minus the 10,000, right? So that's the remaining amount that we need to distribute to these two people. That's just what is left over, right? So that's number 3. Going into distributions of non-cash property to shareholders. So the current accumulated E&P and just earnings and profit in general, that was the easy part, right? We know that we have 3 steps. Calculating earnings and profit is a little bit more difficult, but as soon as we can run through those 3 steps, we'll be fine. Distributions of non-cash property into shareholders, a little bit more difficult than earnings and profit, not as difficult as stock distributions. So let's get through it, right? We need to determine the amount that we have distributed. So we need to take the money received, which is cash, add our fair market value of other property received, and subtract out our liabilities assumed. Now, we are looking at this as the shareholders. So right now we are looking at this as from a shareholder's perspective. That's going to be the amount distributed to us. So tax basis is sometimes recognized as fair market values plus liabilities, but I would say for the most part, we need to recognize our tax basis as fair value. Okay. Effects on the corporation. This is where we just talked about it from a shareholder's perspective. Now we want to look at a corporation perspective. When the fair market value exceeds the tax basis in a distribution, the corporation must recognize a gain. Okay, so the tax basis in a distribution, that means maybe something like a truck, right? If we've given a truck to our shareholders or a parcel of land, not quite land because we wouldn't have depreciated land, but let's say a truck, we might have depreciated a truck. So that truck has been depreciated and now we have a tax basis in it as, let's say we bought it for 40,000 and now we have a tax basis of 10,000. Let's say that the fair market value is 15,000. So then the corporation would need to recognize a $5,000 gain. We can't recognize losses on property distributions. And I've added this in there because the textbook says this. I think it's kind of confusing that it adds it in there, but we'll work through it. We can only recognize losses on a sale of property if the shareholder does not own more than 50%. So this just means that we can still sell property to shareholders as long as they are not controlling shareholders. Let's work through an example. SCR has an adjusted tax basis of $650 in the Fuji Custom touring bike that it distributes to Ginny. How much taxable gain, if any, does SCR recognize when it distributes the bicycle to Ginny? And the fair market value of the bicycle is $1,000. So fair market value exceeds tax basis by $350,000. And that's all. That's all. Seriously. The fair market value exceeds the tax basis, so fair market value minus tax basis. Let's look at another one. SCR has an adjusted tax basis of $1,200 in the Fuji Custom touring bike that it distributes to Ginny. Fair market value is still $1,000. So we need to recognize a loss? Maybe? No. We cannot recognize a loss on a distribution to our shareholders, not on a distribution. If we sold this bike to Ginny, and as we know, Ginny only owns 25% in the corporation, we would recognize a $200 loss, but not as a distribution. Liabilities on property. So I think that this breaks liabilities on property up nicely. If our liability is less than fair market value is our new tax basis as a shareholder, right? And then to calculate a gain, we need to find our fair market value minus our tax basis. And that's exactly what we did in the last example. We took that $1,000, subtracted the tax basis of $650, and our gain was $350. But if a liability exceeds fair market value, then the liability becomes fair market value. So then we just do the exact same thing, switch out fair market value for the liability minus the tax basis equals the gain on the distribution. Let's look. So Jacob receives land with a fair market value of $60,000 and a remaining mortgage of $12,000. SCR has a tax basis in the land of $20,000 and Jacob assumes the mortgage on the land. How much of a gain, if any, does SCR recognize when it distributes the land to Jacob? We are going to recognize a $40,000 gain. That is just the fair market value, like we talked about in the equation, minus the basis in the land. What if the mortgage was $75,000 instead of $12,000? So now we can see the fair market value of the land is still $60,000. And we said that if the fair market value was less than the liability becomes the fair market value. So we're going to recognize a gain of $50,000. We can see that because that is $70,000 minus $20,000 tax basis in this land. Effects on current earnings and profit. Even more difficult, right? So differences in tax basis lead to different gain recognition. Our fair market value minus our taxable tax basis is a gain recognized for net income and tax. However, if our gain recognized for tax purposes and E&P purposes, which would be if the E&P basis in an asset is different to the taxable basis in an asset, we would recognize different gain amounts for our E&P calculations. Something where this might happen is looking back at our truck. If we used bonus depreciation, our truck cost us $40,000. So our truck cost us $40,000. We used bonus depreciation, which is 60%. I'm going to say 50 because I can't do math in my head. So let's say 50%. We depreciate it, $20,000 in its first year. Now, what about the ADS system? I don't know the ADS system, so I'm going to use 10%. 10%, so then we only depreciate $4,000 using the ADS system in the first year of the truck's life. So the tax basis for the truck, for tax purposes, would be $20,000. For E&P calculations, it would be $36,000. If we sold this truck, the gain recognized would also be different. So we would need to adjust the gain. This will affect current E&P if our taxable gain, so let's say our taxable income was $10,000. We've already recognized a taxable gain of $20,000. We would need to increase our amount by $16,000 for E&P calculations, right? To bring that up to $36,000. Losses, however, cannot decrease an E&P basis. So, or E&P calculations, or basis, both. So if we had a loss of, let's say, negative 2,000 for this truck, we wouldn't do anything. And let's say that we had a negative 2,000 for both, for taxable and for E&P calculations. We would not do anything to our $10,000 beginning current earnings and profit. We would leave it alone because we cannot decrease current earnings and profit due to a loss. SCR still has an adjusted tax basis of $650 in the Fuji Custom touring bike for income tax purposes, but has an adjusted basis of $400 for E&P purposes. The fair market value of the bicycle is $1,000, and SCR recognizes a $350 taxable gain on the distribution. We want to know what is the adjustment that we need to make when computing current earnings and profits. The answer is $250. We find this by first doing our taxable gain of $350, which we find by doing our $1,000 minus the $650. But for E&P purposes, because the adjusted basis was $4,000 and the $400 and the fair market value was $1,000, we recognize a gain of $600. So the difference between those two numbers is $250. We are going to add the $250 to the gain already recognized $350 to get to our current E&P, or adjust our current E&P. Effects on accumulated E&P. So just a couple of things to look at. Our appreciated property reduces accumulated E&P by our fair market value. So that would be like a house. If a house has appreciated from $200,000 to $400,000, then we will recognize $400,000 that will reduce our accumulated E&P. After the distribution, if we distribute the house that is worth a fair market value of $400,000. However, like our truck, if we have depreciated a property, let's say that we bought it for 40,000, we reduced it to a tax basis of 10,000. We'll reduce accumulated E&P by the $10,000 tax basis. Also, any liability assumed by shareholders increases AEMP. Why is that? Why would a liability increase AEMP? That's because the company was previously on the hook for these liabilities, right, from mortgage on a parcel of land. When we distribute these things to shareholders, we are no longer obligated to fulfill those liabilities. So let's look at an example. We distributed land to Jacob that has a fair market value of 60,000 and a remaining mortgage of 12,000 attached to it. SCR has an income tax and E&P adjusted basis for the land, so they've made it nice and lovely for us. It's the same tax basis as $20,000. Jacob has assumed the mortgage on the land. SCR has current E&P of $100,000, which includes the net gain of $31,600 from distribution of the land. Accumulated E&P at the beginning of the year is $50,000. So we are going to start with our, let's look. We're going to start with our accumulated, that says accumulated depreciation, and it should not. It should say accumulated E&P of $500,000. We need to add in our current E&P of $100,000. Then we need to subtract out, like we said earlier, our fair market value of the land distributed because it has appreciated. So we're going to subtract out our fair market value of the land of $60,000. We also need to recognize that we have increased our AEMP by 12,000 since Jacob has assumed this liability that we were previously obligated to pay, which leaves us with ending AEMP of $552,000, right? One more thing, why do we ignore the $31,600? It's already included in the current E&P calculation, so we've already recognized that.